After studying this module, you shall be able to know the meaning of types of inventory, learn various techniques of inventory management, analyze the impact of various inventory policies on the costs of inventory, evaluate the various policies, and choose the optimum level of inventory. Inventories are one of the important current assets of the firm. They require certain investment. The funds of the organization are blocked in inventories. Therefore, losing interest on this fund becomes the opportunity cost of holding inventories. However, there should still be an optimum level of inventory. If the level of inventory is too low, the firm may lose opportunity of sales and maybe goodwill. If the level of inventories is too high, it entails unnecessary blocking of funds. That is why inventory management constitutes important segment of working capital management. The term inventory does not include goods and services being sold only, but also includes raw materials or other components being used in manufacturing of such goods. The type of inventory depends upon the fact whether it is a case of retailer or a manufacturing concern. It is quite obvious that retail shopkeepers will keep inventory of finished goods only, whereas the manufacturing concern will maintain inventory of raw materials also. The inventories for most of the business firms may be classified as raw material, work in progress, finished goods, stores and supplies. Raw material. It includes material which the firm uses in the production process. A firm must hold certain stocks of raw material in its stores so that production process goes on smoothly without any interruption. These units of raw materials are regularly issued to the production department. The quantity of raw materials to be kept by a manufacturing firm depends upon many factors. For example, availability of raw material, price of the raw material, consumption pattern of the raw material, lead time, that is, time taken to replenish the stock. Work in progress. The raw material which is engaged in various stages of production schedule on which certain degree of labor and overheads have been employed is known as work in progress inventories. The degree of completion may vary for various units. Some units might have been just introduced in the production process, while others may be near completion. It refers to partly produced goods. The quantity and value of work in progress depends upon the length of production cycle. The shorter the length, the work in progress inventories would be small. And if the production cycle is lengthy, the value of the work in progress inventory would be large. Finished goods. These are goods which are complete and ready for sale to the customers. They may be purchased or produced. The level of finished goods depends on how promptly the customer requires his demand to be met. In competitive markets, the firm must hold large level of finished goods so that it may not lose sales. Stores and supplies. Stores and supplies include fuel, coal, cotton, chemical, etc. They do not enter the production process directly but are needed to run the production process smoothly. Through efficient management of inventory, the wealth of owners will be maximized. To reduce the requirement of cash in business, inventory turnover should be maximized and there should be no loss of production and sales arising from its being out of stocks. The main purpose of inventory management is to keep inventories at appropriate level. If inventory levels are high, there would be no loss of production and sales. Both the functions would be carried without interruptions. But there is always a cost involved in the inventories. The cost would include the capital cost of the stock and the costs of storing, that is, rent, insurance premium, etc. On the other hand, if stocks are kept at low levels, the cost of capital and storing costs would be avoided, but there can be stock out costs. The cost of stock outs may be sales loss or customers dissatisfied. It may also cause delay or holds up in the production process. Thus, there has to be a balance between the two. There is a level of stock which is optimum or most appropriate. Inventory management seeks to determine this level and maintain it. Thus, the objectives of inventory management are twofold: to ensure continuous supply of raw material in adequate manner, to minimize the investment of funds in the inventories. The optimum level of inventory depends upon the features of a particular firm. If it is a trading firm, it procures goods and sells them. So if the firm has stocks with it, it can sell goods even if supply of goods has stopped. But if the firm has no stocks with it, sales will stop as soon as procurement stops. Therefore, the firm must maintain optimum level of inventory if it does not want to lose its share in the market to its competitors. Similarly, if it is manufacturing firm, it processes raw material and converts it into finished goods to sell. It must maintain optimum level of raw material as well as optimum stocks of finished goods so that production process goes uninterrupted and sales activities do not stop. In the process of manufacturing, various levels of work in progress inventories also arise. The firm must consider various expenses which are involved in holding inventories. The major costs involved in inventory management are carrying cost. It is the cost incurred in keeping an inventory of one unit of raw material or work in progress or finished goods. Major components of carrying costs are the following: interest cost or cost of financing. It includes the cost of funds invested in the inventories. If we block our funds in buying or maintaining inventories, the same cannot be invested elsewhere to generate returns. This becomes the opportunity cost of investing in inventories. If borrowed funds are used to purchase goods, then the interest cost is direct cost of financing. Therefore, the higher the level of inventory, the more will be carrying cost. Cost of storing the inventory. The inventory that is piled up requires space to be kept and needs to be insured and taken care of. These are the additional costs of carrying inventory. Ordering cost. The cost of acquiring inventory is the ordering cost. It includes cost of communicating with the supplier and the freight cost. It includes cost of stationery, paperwork, etc. The less the number of orders, the less would be the ordering cost. The less number of orders also imply more units are ordered. Thus, carrying cost and cost of ordering are the opposite forces and together determine the level of inventory. Let's take up one illustration. The purchase manager of an organization has collected the following data for one of the A-class items. Interest on the locked up capital 20%. Order processing cost for each order rupees 100. Inspection cost per lot rupees 50. Follow-up cost for each order rupees 80. Pilferage while holding inventory 5%. Other holding cost 15%. Other procurement cost for each order rupees 170. Annual demand 1000 units. Cost per item rupees 10. Calculate ordering cost per order, carrying cost per annum. Solution. A. Ordering cost per order. Following the calculations in which we add order processing cost for each order, inspection cost per lot, follow-up cost for each order, and other procurement for each order, we get total ordering cost per order equal to rupees 400. Carrying cost per unit per annum. Adding interest on the locked up capital, pilferage while holding inventory, and other holding cost, the total carrying cost per unit per annum turns out to be 40%. Techniques of inventory management. Various techniques have been suggested which help us in balancing out the expected costs and benefits of maintaining inventories. They are ABC analysis and economic order quantity, in short EOQ. We will discuss them in detail now. ABC analysis. ABC analysis classifies various items of inventory into three groups. The most important and valued items are classified as A group. Those of intermediate importance are classified as group B, and the balanced items are classified as group C. These groups are created on the basis of total value of annual consumption. An item with the highest value is given the highest priority. These items are then arranged in descending order of cumulative value. Cumulative value is also expressed as a percentage of total. Then the cumulative percentage of consumption value is divided into three categories: A, B, and C. Generally, group A consists of cumulative percentage total of 55 to 65%. B group consists of 25% to 30%, and the remaining items are placed in the group C. Let us suppose that the following is the consumption of different items of inventory having the following values as given in the table. The first step would be to arrange the items in order of priority. For example, our item number 2 has a value of rupees 6 lakhs, which is the highest value. So its priority will be 1. The second highest value of 5 lakhs goes to item number 1. Therefore, it gets the second priority and so on. Item 2, 1, 5 are classified as group A, comprising 62.5% in value, but the total items in number is 17%. Item 6, 9, 10 are classified as group B, comprising 27% in value and 32.5% in number of items. Item 7, 4, 3, 8 are classified as group C, comprising only 5% in value and 50% in item of number of items. Economic order quantity, in short EOQ. This technique determines the order size that will minimize the total inventory costs. The total costs comprising ordering costs and storage costs are minimized with respect to quantity order. Thus, EOQ is equal to under root of 2UP upon S. U upon A is equal to annual uses of the item. P upon B is ordering cost per order of the items. S upon C is carrying cost of 1 unit per annum. The model is based on the following assumptions. The total uses of a particular item for the year is known with reasonable certainty. The cost of the item remains constant throughout the period. The inventory item will be used evenly throughout the period. There is no time gap between placing the order and getting it supplied. There are mainly two costs associated with the inventory, that is, ordering cost and storing cost. Storing costs are also constant and known beforehand and expressed as a percentage of cost value of inventory. Consider this example. Let annual usage U is equal to 20,000 unit. Ordering cost P is equal to rupees 500 per order. Carrying cost S is equal to rupees 20 per units per annum. EOQ is under root of 2 UP upon S, which is as under 2 into 20,000 into 500 divided by 20 and take the under root of that, which comes to 1000 units. Now let's consider one more illustration. A firm purchases 2000 units of a particular item per year at a unit cost of rupees 20. The ordering cost is rupees 50 per order and the inventory carrying cost is 25%. Determine the optimal order quantity and the minimum total cost including purchase cost. Solution: optimal order quantity EOQ is given as 2AB upon C. Given A is 2000 units, B is equal to rupees 50 per order, C is 25% or 0.25 into 20 is equal to 5 rupees per unit per annum. Hence, optimal order quantity is equal to 2 into 2000 into 50 divided by 5. Take under root of that, which comes to 200 units. Consider another example. A company manufactures a product from a raw material which is purchased at rupees 60 per kilo. The company incurs a handling cost of rupees 360 plus freight of rupees 390 per order. The incremental carrying cost of inventory of raw material is rupees 0.5 per kg per month. In addition, the cost of working capital finance on the investment in inventory of raw material is rupees 9 per kg per annum. The annual production of the product is 1 lakh units and 2.5 units are obtained from 1 kg of raw material. You are required to calculate the EOQ of raw materials. Advise how frequently should the order for procurement should be placed. Solution: 1. Buying cost per order is equal to handling cost plus freight charges. In this case, it comes to 360 plus 390 is equal to 750. We can term it as B. 2. Carrying cost per kg per annum is equal to incremental carrying cost, that is storage cost, plus financial cost, which comes to 0.50 into 12 plus rupees 9. The total comes to rupees 15. The annual requirement of raw material is 1 lakh divided by 2.5 is equal to 40,000 kg. So EOQ is equal to 2AB divided by C under root, which in our example is 2 into 40,000 into 750 divided by 15. Take under root of this, which comes to 2000 kg. Number of order per year is A upon Q, which is 40,000 divided by 2000 is equal to 20. Time lag between two orders is equal to 365 divided by number of orders per year. That is equal to 365 divided by 20 is equal to 18 approximately. In a firm, the annual demand for raw material is 6,000 units and the purchase price is expected to be rupees 90 per unit. The cost of processing an order is rupees 135 and cost of storage is estimated to be rupees 18 per unit per annum. A. You are required to determine the optimal order quantity and total relevant cost of this order quantity. Suppose that is rupees 135. An estimate of the cost of processing an order is incorrect and should have been rupees 65. Assume that all other estimates are correct. What is the cost of this prediction error assuming the solution to part A is implemented for 1 year. Solution A. Optimal order quantity EOQ is equal to under root 2AB upon C, which in our example is 2 into 6000 into 135 divided by 18 under root, which comes to 300 unit. Total relevant cost at EOQ is equal to total ordering cost plus total inventory carrying cost. This is equal to A upon Q into B plus Q upon 2 into C, which in our example comes to 6000 divided by 300 into 135 plus 300 divided by 2 into 18. This is equal to 2700 plus 2700 is equal to 5400. In case the optimal order quantity when buying cost is rupees 60, the EOQ in this case will come to 200 units. So the total inventory cost for 1 year is equal to 6000 divided by 200 into 60 plus 200 divided by 2 into 18. This is equal to 1800 plus 1800 is equal to 3600. Hence, the cost of prediction error is equal to 5400 minus 3600 is equal to rupees 1800. A manufacturing company purchases 24,000 pieces of component from a subcontractor at rupees 500 per piece and uses them in assembly department at a steady rate. The cost of placing an order and following it up is rupees 2500. The estimated stock holding cost is approximately 1% of the value of average stock held. The company is at present placing orders which at present vary from an order placed every 2 months, that is 6 orders per annum, to 1 order per annum. Which policy would you recommend? You can see a statement showing evaluation of the different policies in which total cost including ordering cost and carrying cost have been calculated. The calculations recommend that the company should follow a policy of placing 5 orders per annum, that is order size of 4800 units, because the total annual cost is least in this case. ABC Limited purchases 9000 units of spare parts for its annual requirement, ordering 1 month uses at a time. Each spare part costs rupees 20. The ordering cost per order is rupees 15 and carrying charges are 15% of unit cost. Do you think it is the correct policy? If not, suggest a more economical purchase policy for the company. Also find out the total annual cost of inventory, ordering and carrying. 1. Computation of economic order quantity EOQ is equal to 2AO divided by C under root, where A is equal to annual requirement, O is ordering cost per order, C is carrying cost per unit per annum. In the given question, A is 9000, O is 15, C is 15% of rupees 20 is equal to 3. So EOQ in this case comes to 2 into 9000 into 15 divided by 3 under root, which is equal to 300 units. You can see a comparative statement of inventory cost wherein the costs have been calculated for the existing policy and that of economic order quantity. The statement suggests that the policy of the firm is not correct. It should purchase an economic order quantity. Saving in inventory cost if EOQ practice is accepted is equal to 1305 minus 900 is equal to 405. In this module, we have learned inventories are important current assets of the firm as it requires certain investment and the funds of the organization are blocked in this. The major type of inventories for most of the business firms are raw material, work in progress, finished goods and stores and supplies. The objectives of inventory management are twofold. Firstly, to ensure continuous supply of raw material in adequate manner, and secondly, to minimize the investment of funds in the inventories. The major costs involved in inventory management are carrying cost and ordering cost. The important techniques of inventory management are ABC analysis and economic order quantity within bracket EOQ.